Hey, hi everyone. Apologies for the late start. I had some technical issues. My computer couldn't connect. But we are back, and today's session we are going to be talking about market liquidity, understanding depth and volume. We will have some time at the end of my slides to look at a couple of charts. So if you guys have any requests for any charts you'd like me to go through, feel free to just pop them into the chat and I'll be happy to go through them after I'm done with my slides. Okay, I think without further ado, we can go ahead and get started. But stop me anytime if you can't hear me or you can't see my slides. Yeah. So, okay, let's get started. So, as per usual, before we start, a disclaimer and risk warning. This information is not considered investment advice or investment recommendation, but instead a marketing communication and a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst at Rocket, who were finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We'll look at market depth and volume, liquidity providers, impacts of liquidity on trading, and so on and so forth. Okay, let's start. We'll start off by going through a bit on um, understanding market depth and um, volume in Forex trading. So in the Forex market, market depth generally refers to the measure of supply and demand at different price levels within the order book. So think of it as the amount of buying and selling interest in a currency pair across a range of prices. So when we talk about a market with depth, we're referring to a market with lots of orders at various levels, creating a deeper order book. So why is this important? Because in a deeper market, which means one with a large number of orders on both the buy and sell sides, traders can execute larger trades with minimal price impact. So this means that the price won't move much even when significant trades occur because there's enough liquidity to absorb them. So to visually kind of demonstrate this concept, you can imagine a situation where a large buy order enters your market. So in a market with high depth, this order will be filled by the multiple existing sell orders without significantly impacting the price. But if it's in a low depth market, a single large order may cause a substantial price shift because there isn't enough opposing orders to absorb it. Okay, so when it comes to market depth, there is this market depth chart that I have included here. And it's basically a graphical representation of the order book, showing us the price trends and the patterns that change as pending orders and liquidity fluctuate. So the chart shows your demand and supply levels. That's your X and Y axis. So the X axis represents the market prices, while the Y axis represents the amount of pending orders. So the chart basically enables the trader to understand the price changes and fluctuations in the demand and supply patterns. So through this, you as a trader can evaluate the efficiency of investing in the given security. So you can see the chart is split between two sides, left and right. So it represents the demand and supply of different price levels. So in the best scenario, both sides of the chart will be balanced or almost symmetrical. And any uneven tendencies will be depicted as the graph skews to either side, which represents either market shortage or excessive liquidity. Okay, so here, if you look at the left side of the vertical axis, okay, so the left side of the vertical axis is your buy wall. So the buy wall represents the cumulative value of buy orders placed on the given security at your different price levels. Okay, your buy wall is this side, the green side. And then your sell wall, which is the right side of the vertical axis, represents the cumulative value of the sell order that's placed on whatever asset you are trading at different prices. The vertical y-axis that represents your price level, and your x-axis represents the volume of the pending buy and sell orders that have been placed. So the mid-market price, which is just the middle line going down, between the buying and selling, or it's just the middle point between the buying and selling, or basically your average between the highest bidding price and the lowest asking price. So here you can see, in the case of Bitcoin, the mid-market price, which is the average, would just be 100,000. Okay, so this chart, it works as an indicator, and it works by hovering over the chart, which reflects the number of assets that can be bought or sold at a given price point at a specific time. So it also shows you the cost of executing the market order and the implications on the market value. And TradingView actually has a depth of market chart as well. So I'll show you guys in a little bit how you can use that. Okay. So what's the importance of this chart? It's basically used to predict current and potential market directions, and also discover support and resistance levels, which assist investors in creating their trading strategies. So if the depth chart is tilted to the left, it means that the asset is illiquid and the price will potentially increase because demand is higher than the supply. On the other hand, if the chart is tilted to the right, it means the asset is sufficiently liquid and prices are more likely to stabilize or decline because supply is more than demand. So you can use this information to place suitable market orders. So for example, if the market is skewed to the left, means that there are more buying orders than selling. So there's lack of liquidity. So your product or your security is becoming illiquid and is more likely to increase. So in that situation, you would then place a buy order so that you capitalize on the likelihood of a price surge before selling at a higher price, so that you can reap your gains. Okay, any questions so far? Okay, I'm gonna show you guys the TradingView website, um, which basically shows us how exactly you can use it. You can watch the YouTube video as well, but I'll just briefly go through how you can use it on TradingView since we're talking about it now. So you can click on the trade button in the trading panel over here. Okay, this isn't very important. Yeah. So these are the key elements. I'm just gonna go through them over here. Let me see. Can you guys see my screen? Is it too small? Okay, great. So, oh, you can't see my screen? Okay, I should be sharing screen now. Okay. Yeah, I can zoom in if that helps. So the first bubble is our place orders. Second are your asks and bids. It's number two. Number three would be your bids, so the volume of orders that's available on the market that we just talked about earlier. Number four, okay, let me zoom in. Point four, or the bubble number four, basically are the cells for placing your orders. So when you click on it, a limit order is placed in them, and then when clicked while holding your control button, your stop order is placed. Okay, number five, uh, which is these X's, it's just to cancel or limit or stop orders based on whatever security you are trading. Number six is your centering button. Number seven, the size of number seven is here. So that's just the size of all of your open positions. Number eight is the profit and loss of all of your open positions. And you can also change your display setting. So if you click on it, you can change the element to money, pips, or percentage. And number nine is your closing position. 10, obviously reversal. 11 would just be the button for you to cancel all of your orders on your current security. And number 12 is the quantity field. Um, you can see here units that basically shows how many units of your security you're purchasing or sold when you're placing an order. Okay, so how it works basically is it uses data from the broker, from the specific broker. So data is displayed in static mode, which means that the price series is fixed. So while price moves between these values, it's normally either above or below the designated range. Okay, so I will speed ahead and show you guys how you can place an order. Yeah, so to place a market order, you just basically click on that buy market button from above. And then you can go ahead and indicate the number of units you want to purchase or sell. And then similarly for limit as well, you just click on the cell next to the desired price. I think this is pretty straightforward, so I'm just going really quickly so we can move on and look at have more time to look at more charts. And then for a stop order, you can hold down the control key and click on the cell that you want to place your stop order in. That's in the left column, and buy and right column to sell. Yeah, and then you get a confirmation and you can change your orders as well. Okay, so yeah, I'll just get back to my slides. Are there any questions so far? Okay, we have a question. How how does it work? Okay, so like for example, let's take a random asset, right? And maybe it's currently priced at $1. The DAOM will show how many orders there are for prices of 90 cents or maybe $1.10 and so on. So in doing so, it will show you the supply and demand for that asset without having to switch tabs or to manually track. How did you display it as chart? Okay, let me open my trading view and we can go through this. Okay, let's go back here. Okay. Um, what do you mean by how do you display it as a chart? The market depth. So in order for this to work, you actually have to connect your TradingView account to your brokerage account first. Which graphic? This is just on the TradingView website. I'll just I'll just pop the link into the chat. Okay. Let's go ahead and continue. So next, we'll just quickly look at the role of trading volumes now. So when it comes to volume, it's basically simply put the total amount of an asset. So it can be like your currency pair or whichever security like traded over a specific period. So it's a powerful indicator of the market's interest in a given asset and can signal potential future price movements. So high volume often reflects strong market interest. So um, for example, when trading volume is high, it can indicate that many traders are engaged or possibly, confirming the strength of your trend. So in the case of a low volume, it might show lack of interest or uncertainty, which can make price movements less predictable. Okay, so if we take a closer look at the difference between high and low trading periods and how they might influence price directions. Here it says, for instance, high trading volume often accompanies strong trends, meaning that if the price is moving upward or um, downward, a high volume can confirm that movement. So on the other hand, low volume periods can lead to erratic, unpredictable price movements because there are fewer active traders to support a clear trend. So to visualize this, you can imagine a currency pair that's experiencing a strong uptrend with high trading volume. So this high volume basically supports the trend and adds stability to the upward movement. So it makes it less likely to reverse suddenly. However, in a market with low volume, say um during a holiday maybe, price movements may be much more volatile since there's fewer active traders. So there might be quite rapid and unexpected changes because of that. Okay. So if there's more sell orders than buy orders, prices likely to drop. Yeah. So when there are more sell orders than buy orders in the market, there's kind of that imbalance, and that typically will drive price down. So that happens because there's more supply um, of sellers wanting to sell than demand, which is basically buyers wanting to buy at your current price. Okay, I hope that answers your question. Okay, great. Okay, let's now look at the relationship between depth, volume, and price movement. So if we bring all of both basically all of that together, In general, high volume and deep markets will tend to have less price volatility. So that's kind of the relationship between that. So high volume and deeper markets have less price volatility. Reason being that these are stable conditions where you're likely to see smoother price action with fewer sudden spikes or drops. So high volume and high depth provide a kind of buffer, absorbing large trades and reducing the likelihood of erratic price changes. On the other hand, low volume or low market depth can create the opposite effect. So in these conditions, price volatility increases, meaning you're more likely to see sharp price spikes or sudden drops. For example, in a low depth market, even a modest buy or sell order might shift prices significantly because there aren't enough opposing orders in the book to counterbalance it. So we can look at this by thinking about two scenarios. So during quiet times, such as weekends or holidays, the market typically has lower depth and volume. So this creates a volatile environment where even small trades can lead to large price swings. So in contrast, if we think about an active times, so like during a major economic announcement or central bank decision, that will bring higher volume and more market depth. So this depth and volume can provide greater price stability and reduce the impact of your individual trades. Okay, so that's why we often will recommend that you look at your fundamental analysis so that you are kind of aware or you can anticipate these periods of active periods compared to quiet times as well. Okay, so now that brings us to looking at some of the main factors that influence liquidity in the Forex market specifically. So liquidity, as we know, can vary significantly throughout the day and in response to certain events. So understanding these variations can help us to make better trading decisions. The first thing is time of day. So liquidity, we mentioned, changes throughout the day based on trading sessions. So the Forex market operates 24 hours a day, but liquidity is not consistent. So it fluctuates depending on which major trading sessions are open. The main sessions are Tokyo, London, and New York. So typically during the London-New York overlap, which happens around 1 to 5 p.m. GMT, we typically will see the highest liquidity. So this overlap period brings together two of the most or the largest financial centers in the world, which creates more trading activity and tighter spreads and smoother price movements. On the other hand, low liquidity will tend to be during the Asian session and on the weekends. So that's when fewer traders are active. So low liquidity in these events or in these periods can lead to more erratic price movements. So it's generally advisable to be cautious when trading outside of peak hours. Number two would be economic events and news volatility. So these events are pretty significant factors that influence liquidity. So liquidity tends to be high during or on the lead up to scheduled announcements, since traders will tend to take positions based on the anticipated outcomes. So examples of major economic news events would include Federal Reserve meetings, non-farm payrolls, um, unemployment reports, so on and so forth, and also interest rate announcements. So interestingly, while liquidity is high before these announcements, it can drop sharply immediately after, especially if the news was unexpected or significantly impacts market sentiment. So this post-announcement period can lead to increased volatility, making it really essential for you to be prepared for any sudden price movements. Okay. Number three, geopolitical events and policies. So this is also another major factor influencing liquidity. This can be like your elections, wars, and policy shifts. Such events will introduce uncertainty, and when the outcome is unclear, traders will often hesitate to open new positions. So, for example, in times of political tension or economic sanctions, liquidity can dry up because there's a lot of uncertainty about how these events will impact the markets. So that's why we see lower liquidity and increased volatility during your global crises. So events like Brexit or the Russian-Ukraine conflict or even the recent elections can lead to low liquidity conditions um, while traders try to assess their strategies amid the instability. And lastly will be central bank interventions. So this is pretty straightforward, so I'm just going to verbally explain it. Um, Central bank interventions will include things like your Federal Reserve, your ECB, the European Central Bank, or Bank of Japan. So those are kind of the main central banks that will impact liquidity and currency values through their policy decisions. So if they adjust interest rates or they intervene in the FX markets, and they can also use open market operations to either inject or withdraw liquidity from the market. So that's how they influence liquidity. So, I guess just as an example, when a central bank announces a significant policy change, like an interest rate hike, it can increase liquidity as traders adjust their portfolios. So similarly, open market operations where a central bank buys or sells large volumes of currency can have a major impact on liquidity levels. And in turn, that will also affect currency prices. Okay, any questions so far? No? Okay, great. That actually brings us to the end of my slides. Um, so let's go ahead and take a look at some charts now. Okay, I think we'll start off by looking at EXY. Yeah, we'll take a look at gold after this, since gold is inversely correlated to the XY, so we can see how that might affect um the prices. Okay, so on our weekly time frame, we can see the price of DXY is shooting upwards. Let me just connect my mouse. Okay, so on our daily time frame, you can kind of see prices testing this resistance level here. Um, Even though the overall trend is still pretty bullish. Okay, this is gonna be my second resistance. Okay, and for my first support, I'll just place it maybe here. Okay, so this is just purely based off of graphical analysis. So I'm just looking at where the swing highs and the swing lows line up and trying to identify all of the sig significant levels. Okay, now I'm going in with our Fibonacci levels. I'm starting off with a retracement, and you can see my 50% lines up. Okay, I'm trying to see if we have any projections here. Our 61 kind of lines up and 78 as well. So just keep those two. Okay, I have another projection here. I think. Okay, so my 100% also lines up with my first resistance. Even though the 61.8 does line up nicely with our first support, we can't use it anymore because price has already broken out of that level. So we'll just use the 100. And for our retracement, okay, my 38.2 lines up with my first support. Okay, I think this is our confluence area because we have about we have two Fibonacci levels that line up nicely. So if you're not familiar with confluence levels, um, they're basically when two or more Fibonacci levels line up in that same area. And what's significant about it is that prices tend to be attracted to these areas, but might not be able to push past them. Okay, so that's why we want to try and identify these levels. Like you can see here, it's a confluence area, and you can see price has also tested this level multiple times in the past with 1 and 2, 3 swing highs. So now you can see price is facing a bit of resistance here. Okay. Now let's take a look at some indicators to see what they're telling us. So I like to use Ichimoku and MACD because at one glance you can tell exactly what the signals are. So with MACD, it's giving us a bullish signal. Ichimoku is also giving us a bullish signal. Let's look at Bollinger Bands. Okay, it's also pushing above the upper band of the Bollinger Band, so that's also giving us a bullish signal. And we normally will recommend you to follow the general trend, which we can see here is pretty bullish. But we just want to highlight this level just in case, just so that you are aware of any potential reversals of this level. So as of right now, it is pretty bullish. I'm just gonna just have to be careful about this confluence area here. Okay, let's maybe look at some momentum indicators. RSI, stochastic. Okay, so we have prices moving in an ascending trend line on our RSI. Let's take a look and see if, okay, on our stochastic as well. So they're all of the indicators that we've used so far support our bullish analysis. Okay, and yeah, this is on our daily time frame. Okay. Um, any questions before we move on to gold? No? Okay, let's move on to gold now. Okay. So, like I mentioned earlier, gold and DXY tend to be inversely correlated, because they're both seen as safe haven assets. Um, but in the event of, geopolitical events, there are occasions where they do move in the same direction. As of right now, you can kind of see prices of our DXY going up, and while our gold is dropping quite significantly. Okay, so on our weekly time frame, prices are moving downwards, daily as well. Maybe let's look at our 4 hours. Okay, we can see prices moving in a downtrend as well. So going ahead with our horizontal levels, this will be our first resistance, second resistance, or maybe further down here. Okay, because it's in line with two swing lows. And then for my first support, I'll place it mm, okay, maybe down here. Since it's an overlap level, it's in line with multiple swing highs and swing lows. Okay, so going in again with our Fibonacci levels, you can see my 38 and 61 both line up. Mm, okay, no. I think my 23 lines up. Yeah. So my 23.6 lines up with my second resistance. Um, we might have an inverted Nike tick here as well. Yep, so my 161 also lines up. Okay, it lines up with my first resistance. For reference, this is the Nike tick I'm talking about. It's inverted, so if it's upright, it'll look like that. Now it's kind of upside down like that. Okay, so this area is also a confluence area. So you can see price kind of testing that level as well. Oops, okay, I labeled it wrongly. This should be our first support. And then this should be our second support. Okay, because I'm expecting price to continue to drop. Okay, again, this is just kind of like a warning because it's in line with a swing high and swing low, um, and also with multiple Fibonacci levels. Okay, so let's pull out some indicators again. So price is moving below the cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal, so they both support our analysis. Bollinger Bands, price you can see pushing below our bottom band, so that's also supporting our analysis. Okay, there isn't really a descending trend line here, so I'm going to remove that. But you can kind of see prices moving into the oversold regions. Um, here's here as well on our stochastic. Okay, but I'm not gonna use that for now. Let's maybe look at our parabolic SAR. Okay, we have prices moving below the indicator, so that's also a bearish signal. Okay, if you want to be a little bit more careful, you can add yeah, I was gonna add this kind of like an intermediate level here instead, in line with the 50%. Because that's where I wanted to place it originally, since it's in line with a whole bunch of swing highs in this area. So it is quite a significant level, also because it's in line with a 50% retracement. So we have a couple of things supporting this level. 50, 61, and 32, 38. Okay, any questions? Okay, if not, since we briefly talked about looking at an economic calendar to keep up with, all of the announcements, um, I just really quickly want to show you guys Forex Factory. This is just an option that you can look at to keep up with your fundamentals. So you can look at the events for the week or for the month, whichever you prefer. And you can see I have it to only focus on the orange and red, and that's medium to high impact events. There's also low impact, which is the yellow, and non-economic, which is the gray. And that includes any like bank holidays, which, as we have seen during our slides, those are low liquidity periods. So it's quite important to know those as well. Okay, so like this week we had the French bank holiday, Canadian bank holiday, so you would try not to trade those during that time. US bank holiday as well yesterday. So yep. And it also gives you the actual forecasted and previous values. So once the actual value is out, you are able to compare at one glance. So I normally just prefer to look at the orange and red icons, or maybe any bank holidays for reference. And you can see it's a lot more streamlined and it's easier to go through and keep track of the events for each week. Okay, and it also helps you to categorize whether it's a high impact event. So like we mentioned earlier, unemployment rates, non-farm payrolls, central bank announcements, or uh, yeah, I think inflation as well would typically be considered a high impact event. So yeah, you can look at this for reference as well. Okay, are there any questions? Okay, if not, that's all I have for you guys for today. Thank you guys so much for joining me. I hope you guys found this session helpful. Have a great rest of your week, and I will see you guys again next week. Thanks, everyone. Bye. Thanks, everyone.